Today, I want to share a small presentation I put together on Elliott waves and give you a simple explanation of how this whole concept works. Personally, I see this theory mostly as a reflection of human psychology. On the chart, I try to illustrate how and at what moments retail traders typically enter the market. And this applies to any market: crypto, forex, stocks. It doesn't really matter. At the core, markets always move in two phases. First, the impulsive phase. And this is the main trend, made up of 5 waves: one, two, three, four, 5. Then comes the corrective phase, 3 waves against the trend, A, B, C. So one full cycle is 8 waves in total: 5 up, 3 down. And once the ABC correction is complete, a new impulse begins again in the direction of the trend. Now let's break down the impulse waves. Wave 1, this is the initial move. It's usually not very strong and often goes unnoticed. It typically starts right after a correction ends, either as a breakout from consolidation or a reversal. Volume begins to increase here. Wave 2, this is a pullback of wave 1. There's one strict rule: it can never retrace 100% or more of wave 1. Most of the time, it pulls back around 50 to 61.8%. It usually happens on lower volume and feels like a healthy dip. This is where a lot of traders start buying the dip. Wave 3, this is the strongest wave, almost always. It's the most aggressive move on the chart. Strong momentum, large candles, volume expansion. Wave 3 can never be the shortest of the impulse waves. This is where trends really take off and where FOMO begins to kick in. Wave 4, a correction after wave 3. It's usually more complex and takes more time than wave 2. There's another key rule: wave 4 should not overlap the price area of wave 1. Typically, it retraces about 23 to 38% of wave 3. Wave 5, the final push in the trend direction, often weaker than wave 3. This is where you start to see divergences on indicators like RSI or MACD. Sometimes it extends and sometimes it fails to make a new high or low, which can be a strong signal of a coming reversal. After any 5 wave move, we always get a correction. The classic ABC structure: wave A, the first move against the trend; wave B, a partial retracement of wave A. Very often, this feels like a fake breakout or even a trap. Wave C, the final leg of the correction, usually strong, impulsive, and often longer than wave A. There are also different types of corrections: zigzag, sharp and aggressive; quick moves; flat, more sideways; slow, choppy price action; triangle, a contracting structure usually forming in wave 4; and more complex corrections, combinations like double or triple structures. Another key concept is the fractal nature of the market. Every wave is made up of smaller waves of the same type. A big impulse wave contains 5 smaller waves. A correction contains 3 smaller waves. That's why on the chart, you often see waves inside waves. You start with the bigger picture, for example, on the daily time frame, and then zoom in to find the same structures on lower time frames. Now, the golden rules: if even one of these is broken, your wave count is most likely wrong. Wave 2 can never retrace more than 100% of wave 1. Wave 3 can never be the shortest among waves 1, 3, and 5. Wave 4 cannot overlap wave 1. These are fundamental. To measure all of this, we use Fibonacci. Wave 2 typically retraces 50 to 61.8% of wave 1. Wave 3 often extends to 161.8% or even 261.8% of wave 1. wave 4 retraces around 23 to 38% of wave 3. Wave 5 is often equal to wave 1, or about 61.8% of it, and wave C is usually around 161.8% of wave A. One important thing to understand: wave analysis is subjective. There is no single correct count. You always need to keep alternative scenarios in mind. If something doesn't fit, you might not be looking at wave 3. It could actually be part of a larger correction. And finally, Elliott waves work in any market and on any time frame, because at the end of the day, this is all just a reflection of human behavior. Fear, greed, FOMO, panic, and the real edge here comes from experience. The more charts you go through, the better you start to see these patterns, almost intuitively. You can find the presentation itself and my trades on my Telegram channel.